Good morning or good day. Welcome to our real-time daily trading ideas webinars series. We have 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screening, maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick and smart like every day. Today it's Monday, 5th of April 2019. So let's have a nice start like every day. And of course, we will start with our risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk which is not suitable for all investors due to their complex nature. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full risk disclaimer, just visit one of our regional web pages, for example, admiralmarkets.com, and you will find the long version of the risk disclaimer there. There you will find also some information about the year 2019. Yes, we are 18 years of Admiral Markets. We celebrate our anniversary. And of course, the different offers and options in the European Union for retail clients and professional clients. Check it out on admiralmarkets.com. This is me. My name is Jens. My English made in Germany, but I'm not the main speaker. The main speaker is the day trader of today. And this is our scheme. On Monday, like today, it's Jay's Day. Tuesday, it's Paul's Day. Wednesday, it's Giancarlo's Day. Thursday, Marco's Day. On Friday, it's Dirk's Day. Our leading day traders live every business day, every trading day to the same time. And of course, if you'd like to trade Forex and CFDs, you will get many benefits only with us. For example, one of our bestseller DAX 30 CFD triple split of just 0.8 points from 8 a.m. CET to 10 p.m. CET, or Euro-Dollar 0.6 pips equal spread without additional commission. Check it out on admiralmarkets.com. Enough from my side. Now it's time to Jay. For Jay, good morning, good day, Jay. What's your view to the markets today?
Good morning, Jens. Good morning, guys. I hope you can hear me okay. Let's see if you can see the window. Excellent. Great to have you. Great to have you. All right, we had another good week last week. We had a possible trade opportunity long Canadian dollar versus the Swiss franc. The reasoning we're here. I got into the trade right away, and we had I actually had on this account, I took an early profit. On the other account, I took it around here. 56 pips max, almost to the full gray zone, which is the expected turnaround. Now we have a failed auction, so expectation for it to go lower depends also on the oil price, which may come off a little bit as OPEC Plus and Russia are talking about potentially dropping the supply limits for Russia, as Russians are trying to combat the supply coming out of US shale production. On the Swissy side, we have S&P Jordan over the weekend stating that he is ready and able to intervene. The Swiss franc is still too high for his liking. As always, a great candidate to short. We have numbers coming in on Thursday, expected to become weaker or getting weaker. So we had stronger numbers this morning. So Swissy seeing some strength this morning. Headlines, what else is going on? Asia starting green into the new week on the back of Chinese data that came in good end of last week. And we had JP Morgan taking off some of the concern that the US earnings season may start off weak. Did not. Nevertheless, I continue to hold a short for now into US financials. I need to be a little bit careful on that one. There's some risk on creeping into the market. Happy days for a Goldilocks landing, i.e. Central banks in the Western world getting more dovish. Tame inflation globally means risk on equities long, and we can see that here for our semiconductor ETF. It's an indicator for us in terms of US-China trade talks, and those are progressing well. The US are softening some of their demands, and it seems that there is a currency manipulation agreement has been reached. On the IMF side, they came out with their global risk, i.e. their global, global economic outlook. And they're seeing global growth tilted to the downside, but firming up next year, i.e. 2020. And that's what the market is currently playing, a bottoming out of the growth trough in the mid of this year, and then recovering growth into next year and next year. 40% of chief financial officers in the UK expect that the Bank of England will not hike, 40% of the CFOs expect a rate hike by the Bank of England in the next year, i.e. 12 months, versus last quarter, 58%. Deloitte did this survey, or they're doing the survey to us. Brexit is starting to take its toll. So the expectation is creeping into the market that the labor growth is actually going to come off in the near term. ECB's nowcast model is signaling only 20% growth in the first quarter and a possible slight slowdown in the second quarter. Nevertheless, the euro appears to be prone for a short squeeze that is due to slightly improving economic numbers and an extremer, or it's not extreme, but a heavy short positioning in the market as short as towards the end of 2016. Brexit, a flexible extension was granted until October the 31st. Prime Minister May remains determined, and this is funny, to secure the UK's departure from the EU by the 22nd of May in order to avoid, it's so ridiculous, I have to laugh, participation in EU parliamentary elections. But it's a little unrealistic because all the guys from Parliament are on 12-day Easter break. I guess I only find this funny. It's hilarious to me. I said they're fucking it up all the way, and now they have to actually participate in EU parliamentary elections. It's hilarious. Anywho, ongoing calls for a second referendum. We have that on the radar. Yeah, and obviously, with 2 weeks, no politicians, we can finally go back to potentially having the pound trade a bit more towards their fundamentals. And here we have the scenario that they look great. Recall that they really look great. And the Bank of England, during their last two meetings, said, hey, we're about ready to hike if that Brexit conundrum would be solved. But that's coming off a little bit. Why? Because this extension also means continued uncertainty. The markets hate uncertainty, so I would not trade the pound from the long side at the moment. Me, i.e. Jay, personally. All right, strength versus weakness this morning. We did see when I hit the desk this morning some strength in the New Zealand dollar and a little bit of recovery in the pound, versus we had the Aussie dollar come off a bit and the US dollar come off a bit. Dollar, speaking of which, Thursday we have retail sales expected to recover a bit on both the control group and on the headline number. We had last month, we had some weakness, and that was partially due to the inability by the tax office to send out the refunds in time. And you need to know that. Had I not lived and breathed the US for that many decades, I would not know this. Everyone and their grandmother is on credit over there. So the tax refund comes in and gets spent on the majority of cases. So tax refund late means retail actually coming off, consumption coming off. Then retail X auto sales also expected to tick higher. We had pretty good auto sales, 17.5 million units sold versus 16.6 prior. And we have RBC stating their opinion on the US consumer. The consumer fundamentals remain solid, with aggregate wages north of 5% growing year on year, savings rate elevated north of 7%, that's pretty rare, and extremely low debt service ratios, high levels of confidence. Yeah, University of Michigan did come in a little bit weaker on Friday, but still we're at really high levels. So all good over in the US. United States personal income, you can see here coming off a bit, but US economy relative to the rest of the world, the best one at the moment. But the Chinese are picking up speed again. But we're not there yet. Let's look at Australia first. Thursday, we have employment change also expected to come in a little bit better with plus 12,000. ABS jobs vacancy growth has slowed from 24% year on year to 10% year on year. It's important because we have a huge housing bubble in Australia, even though the recent regulatory report stated that the banks are in a good position. Even if housing prices were to drop on aggregate by 30%, the bank's balance sheets could take that hit. Even if the job unemployment rate would increase, the banks could take that hit. But what we all need to remember is the housing market is 4 times the size of GDP in Australia. So regardless of what the report says, if shit really hits the fan, I want to see those balance sheets take that hit, and I want to see confidence go to the dump. But for now, expect vacancy growth to slowing, and Westpac jobs index suggests firms may be less confident on lifting employment, but remains consistent with growth around 2.3% year on year. So a little bit less job growth over there. The jobless rate is seen ticking up by a basis point, by 10 basis points to 5%. We had an unexpected fall in Feb. Why? Because we saw a decline in the participation rate. But there's a model out there by Westpac. They run it. If they continue to hold the if the participation rates holds at 65.6, that would generate 31,000 jobs in the labor force. And Westpac, only forecast 8K rise in jobs versus the 12K that the market is pricing in, and that would lift unemployment rate to 5.1. If you see all of that, it's going to be important to see if the Australian dollar reacts to it. If you see a weaker print, the Australian dollar may react to it temporarily. Why am I saying that? Because one bad print doesn't cause the central bank to change course. And what's more important in my interpretation at the moment is the recovery in China. Okay, let's get to China. Wednesday we have GDP ticking tiny little bit down to 6.3% versus 6.4%. On a quarterly basis, 1.4 versus 1.5. I give you a graph right here where you can see nicely that in 2018 GDP growth came off. Of course, it's centrally planned. Of course, they can do with the numbers whatever they wish and desire. And of course, we don't have dependable numbers. But since the Earth is flat and we're all trading off of the assumption that the Earth is flat, these numbers do move the market. So if Aussie dollar numbers come in weaker and GDP in China comes in weaker, then maybe the Aussie dollar advancement will be halted a bit. Recall February and March PMIs alluded to some stability in the world's second largest economy. The IMF World Economic Outlook saw its China growth view revised slightly up for 2019. Should it be the case that China once more comes to the rescue? Well, let's hope so. Industrial production is seen rising 6% from a previous 5.3, and fixed asset investment is also expected to pick up. Here we have the Caixin manufacturing PMI, used to be called HSBC manufacturing PMI, ticking up above 50. Centrally planned, but good to go. That's the recovery from the beginning of 2019, the recovery. And we saw that as well in US stocks, recovering heavily and violently on a V-shaped recovery off of the bottom beginning of January. Okay, so that's the story that's getting played right now. If this recovery continues, also expect strength in the Aussie dollar. Aussie yen already broke out of a very long-term range. So break, hook, and go. That could be a potential long, and one negative employment print wouldn't necessarily hurt the long in Aussie yen. I'm looking to play from the long side, but I am aware of the overhead resistance potentially there. Also has a lot to do with the dollar. If the dollar comes off, you want to be long the Aussie dollar. Okay, New Zealand dollar. What's going on there? We have GDT price index, and as you can see, for 2019, milk prices are coming off a bit. It's roughly 80% of GDP. That's why we're looking at milk prices. Wednesday, we have important inflation numbers expected on a quarterly basis to rise a bit, but on an annual basis to come off. That's a conundrum. It's always the question, what does the market focus on more? Is it the Q&Q, or is it the year-on-year? Is it a mixture? We'll have to see. The nicest print would be, or the nicest trading opportunity obviously would be if they both come off in the same direction, or if they both go higher in the same direction. Oil prices fell at the end of 18 and the beginning of 19. Our estimate is still 5% lower in the first quarter than in the fourth quarter. What does that mean? It actually is an input variable. I keep repeating that on a weekly basis. Oil is an indicator for inflation and inflation expectations. And then we have such a thing that's called base effect, and that drops the headline inflation on an annual basis. One think tank even estimates that the base effect will tank the year-on-year CPI number to 1.6. If that's the case, you want to be shorting the New Zealand dollar. Okay. Yeah, you want to be shorting the New Zealand dollar. Some businesses may have lifted the prices in anticipation of a 7.3% rise in the minimum wage. Yep, I bet you some of you forgot that they have a new minimum wage law that's being implemented. That's raising the costs, and of course, the producers will try to pass that cost increase on to the retail client, to the consumer, i.e. less disposable income, i.e. difficult for the retailer, i.e. 2/3 of the economy is the consumption of the consumer. Bad English, excuse me there. And that actually would increase pressure on the New Zealand dollar. Over to Canada. Monday, today, this afternoon, we have the BOC Business Outlook Survey. Very, very important because that's going to give us some guidance on what the Bank of Canada, which is currently data dependent, may do when it comes to the rate decision on April 24. Focus will be on investment intentions by businesses, on sales growth and slack in the labor force, and the BOC's qualitative commentary. That's always a really good bit. It's the commentary by the BOC in that survey. Recent data, recall, came in a bit softer. Building permits came in red, employment change came in red, manufacturing came in red. But IVPMI came in green. Overall, though, a little bit weaker. And then on Wednesday, we have important inflation numbers, also on a month-to-month basis expected to come in lower, on an annual basis expected to come in higher. Why? Negative effects from energy prices slowly starting to dissipate. Negative effects here means low energy prices, okay? Because we're playing yields. As Forex traders, we're actually rates traders. Thursday, we have retail sales. That's expected to come in better on the back of a rise in gas prices and auto sales. So better auto sales in North America, in the US, as well as in Canada. Keep that in the back of your mind. And here you can see retail sales fighting their way back, inflation fighting its way back. So if oil were to recover, I'm looking to long the Canadian dollar, right? But oil is a little bit toppy here at the moment. Also, we're having some horrific negative demand coming out of gasoline. That needs to turn around first for oil to actually rise. Be mindful of consumption concerns given elevated debt levels and the previous rate rises by the Bank of Canada. Over to Japan. Friday, we have national core CPI expected to come in unchanged. That's the bottom right-hand picture for you. And the bottom left-hand picture shows you on an annualized basis the inflation rate, which is very far away from 2%. Trick question, when was the last time we had 2% inflation in Japan? Hit the chart, take a look at it. Almost 30 years of printing money doesn't help there. The recent bounce in crude prices may see energy inflation climb from 4.7 to around 5.5. And that's also something that you need to keep in the back of your mind. If inflation rises globally, it rises globally, right? Because we have one global oil market. If inflation is coming off globally, it's coming off in each different country, but at potentially different speeds. And that's what we can trade as Forex traders. Fresh food inflation should have picked up, and tight labor market may actually push service inflation up, but we do see subdued demand and falling producer prices. And that means that goods inflation could have softened. Sorry for you, Japan, you're just not getting any inflation. Why should it change? Why should it change? On the other hand, two things. I read one piece from a very large hedge fund this morning that they're looking to invest in Japan on the equity side. If you look at Japanese equities, they're going through the roof. And if you look at continued low inflation, means no pressure for the yen, means actually yen softness, means Nikkei's strength, means have a look at potentially longing Japan equity. And we have an extended golden week this year because the new emperor session is taking place from May 1 as well. So from April 27 through May 6, 10 days, Japanese banks and markets are closed. The market is already shitting their pants about this because you won't be able to settle anything. Some traders are being allowed to trade off of their mobile devices. Some financial services companies are trying to find workarounds, but be aware of this, guys. Better not to have any yen positions on during that period or prior to that period. Have a think if you want to close your positions prior. At least to my traders, that's my advice. Pound, Tuesday, we have unemployment rate unchanged at 3.9. We have claimant count change, 20 versus 27. And we have average earnings index, 3.5 versus 3.4. The market expects employment growth to start easing soon due to the negative effects of Brexit. On Wednesday, we have CPI. You see, it's a big CPI week this week. We have almost every large economy giving us the CPI print, and it's super, super, super profitable to trade that. I cannot stress this enough. So over in the UK, it's expected to tick up a bit, both on an annual basis and on a month. No, sorry, CPI month on month is expected to come in lower. Later Easter and higher utility bills should combine to push inflation higher in April. So we can already pre-position for the next number. 40% of CFOs expect a rate hike versus 58. So that rate hike is slowly getting priced out of the market, the rate hike for 2019. That means pound weakness. Thursday, we have the retail sales. Ooh, dismal number. But hey, CBI and BRC already told us that this number is going to come in pretty bad. So like I said, if I see top edges in the pound, I would be happy to potentially short it. Now, we've had a lot of data. Let's have a look at the one slide. Possible trade opportunity for today, i.e. this week. I'm looking at everything. I looked at Euro New Zealand. I entered that right away. I'm in profit there. I looked at Euro Swiss. I didn't enter it because it would increase my Euro exposure, and I don't want to overdo it because in the long term, I'm not bullish on the Euro yet. But for this week, I'm happy to long it. But Euro Swiss already took off on me this morning. And so what does that leave? A conservative long Euro Yen in the hopes that that mother is going to come back on a retracement. Why? We have saw last week better economic numbers, and we expect better economic numbers out of Europe for this week. And we have this short positioning favoring a squeeze. On the yen side, we are seeing and expecting weaker economic numbers, as we just showed on the slide, especially on the inflation front. And we have a continued risk-on environment. Remember the semiconductor slide I showed early on? Look at Aussie yen going through the roof. Well, not through the roof, but breaking out of the range. We have continued risk on. Equities are green. Chinese data are turning around. So I don't see a risk of sentiment for now. But obviously, what are the risks to the trade? Weaker EU economic numbers and or risk of causing yen inflows. On a chart, pretty easy. Maybe we'll hit back into the weekly pivot. Doesn't look like it. It looks like it's going, gone. But nevertheless, I need to be conservative on this call because it's a weekly call. So a solid retracement into liquidity, looking for a long with a take profit around 126.80 because there is some overhead resistance. Now, it's important to watch right now what they're going to be doing around the 127 level, where we to hit into it, because what's potentially happening right now is that we're having a break, a hook back to the 126.80, 126.90, 127 area, and then a go higher towards 127.50, 128. Okay, so that concludes this morning call, weekly meeting, 23 minutes. I get better and better. I know it was a lot of information, a lot of boring slides, but I'm sorry for that, guys. That's why we're consistently profitable, because we follow the numbers, because institutions follow the data. Nobody looks at a chart. Everybody looks at the incoming data. And he or she who predicts GDP growth and inflation the best makes the most money. I hope you have a solid week. Thanks for showing up. Thanks for Admiral for the opportunity. Have a solid week. Be careful. Don't lose any money. Try to protect your capital. That's going to keep you in the fight. Thanks, guys, and hopefully I'll see you again next week.
Next week not. Next week is Easter Monday. We will have no webinars, but the week after Easter. And so already now, happy Easter to all of us. But tomorrow is another day. We have 5 days a week, 5 different traders. So if you like Jay's style, usually every Monday, but not on holidays, on bank holidays, but every Monday instead of that. And if you don't like it that much and you like more the charting, then join the style of another trader. That's also one of the idea of real-time daily trading. 5 days, 5 different trading styles. Thanks to Jay. Greetings. Have a great start into the week. And if you like to see and watch it again in a couple of hours, it will be available in our English YouTube channel. Just go to youtube.com/AdmiralMarketsFX. Thanks. Bye-bye.